Welcome to GRE. I'm your host, Keith Weinhold. After we discussed the future of real estate the previous 2 weeks, today it is real estate fundamentals, essential and timeless principles to help you build long-term wealth. Today on Get Rich Education. The EQRP system now allows you to shield up to $700,000 of income from taxes every year. My friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. So if you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the EQRP team can fix this. This way you can invest your 401k or IRA in real estate, gold, Bitcoin, and even your own business. So whether you're a full-time investor, retired, or even a dentist with dozens of employees, if you're listening, you qualify. The EQRP works. It's the solution. You'll control your retirement money, kill UBIT, and pay way less taxes. I encourage you to learn more about this strategy and free up your retirement money. Get the newest EQRP special report. Text GRE to 307-213-3475. Text GRE to 307-213-3475. Mid-South homebuyers with over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your return on investment as their North Star. It's no wonder smart investors line up to get their completely renovated income properties like it's the newest iPhone. Headquartered in Memphis with their globally attractive cash flows, Mid-South has an A-plus rating with the Better Business Bureau and 4,000 houses renovated. There is zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate with an industry-leading 3.5-year average renter term. Every home they offer you will have brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and wait for it, a high-quality renter in an astounding price range, $100,000 to $150,000. Get to know Mid-South. Enjoy cash flow from day one at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From South Bend, Indiana to Bend, Oregon, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. We are nearing the holidays. And I'll tell you, I get sappy at Christmas time with all this Christmas music. I mean, really, when else would I listen to 80-year-old music on my entire drive home from the gym? That's what happened the other day. Only this time of year, only now. Since we did discuss the future in the previous 2 episodes, let me confirm, this is still my real voice. No artificial intelligence app yet. Well, I do media appearances on other shows and networks, and I think that people really want to know there is why real estate consistently generates lower risk and higher returns than other investments. That's exactly what it does when you're strategic. So I talked about that strategy here on a show with hosts Zach and Adam earlier. You're going to hear me say some new things and some things that you've heard me say before. But even those things, I tend to say it in a different way when someone else is spontaneously asking me the questions. You also get to see how I explain GRE core concepts to a new audience. So we are pretty pro real estate in this interview. And with that in mind, though, compared to, say, 5 or 10 years ago, the real estate deals are not as good today. Though rents have been up a lot this past, 18 months or so, rent appreciation has cooled off somewhat since this media interview, and cash flows overall, they're just not as high as they were 5 or 10 years ago. That's largely due to higher rates and prices. But even amidst all that, when I talk to people, still no one can name a better place to invest your dollar today than income property with a loan. So enjoy this interview of me. And then after this interview, I'm going to come back with some comments and some more wealth building information that I've never shared with you before.
We are proud to be joined today by Keith Weinhold. Keith, thanks for joining us today.
Hey, Adam and Zach, I appreciate it. It's so good to be here.
Absolutely. So we always like to get started just by learning a little bit about background. Obviously, tell us kind of what got you into real estate and, in today's times, why you stuck with real estate after you got into it.
Sure. What got me into real estate? The short story is friends. It really harkens back to the legendary business philosopher Jim Rohn's quote. You've probably heard it before. You are the average of the 5 people that you spend the most time with. And 2 of my 5 closest friends made their first ever home of any kind that they owned in their life a 4-plex building where they lived in 1 unit. They were able to do that with just a 3.5% down payment on an FHA loan, rent out the other 3 units. It's a program that still persists today. You just need to live in one of the units at least 12 months yourself. Yes, you can do that with as much as a 4-plex building. So I didn't have a lot of money, but that's how I started out with a bang, with a small down payment on a 4-plex where I lived in 1 unit and rented out the other 3. And I just did that in my local market. And through using not very much of my own additional money, through cash out refinancings and 1031 tax deferred exchanges, I kept trading up and up to more and larger buildings. And then I also, at the same time, began investing out of state in single family rental homes because there's a really good opportunity there as well. So that's how I started, and that's where I went.
Yeah, so it sounds like you were house hacking before house hacking was cool.
Yeah, before house hacking was even a term. Yes, this is actually 20 years ago. So I started quite young in 2002. You don't need to be young to start because when I bought that 4-plex building, again, I said you only need to stay there at least 12 months to get that desirable owner-occupied financing, but I actually stayed there 3.5 years before I bought another property. So real estate just wasn't a central thing in my life. It took me some time to connect the dots and really see that real estate is that most proven way to wealth for the ordinary person.
Yeah. Keith, can we talk about that a little bit more in detail about why that is and kind of your opinion on that? Obviously, we're all biased about real estate and active real estate investors, but for someone that's kind of newer in the space, trying to decide if real estate really is the best means to build financial independence and wealth long term, how would you explain it to someone like that?
Yeah, Zach, that's a really smart question. It's really about building your compelling why for investing in real estate versus everything else. And everything else, that often includes things like investing through your retirement account, through an IRA or through an employer 401k or a 403b. And whether you invest inside retirement plans or outside of them, those vehicles are usually mutual funds or ETFs or stocks. And outside of employer matches in retirement plans, basically, what does investing in stocks, mutual funds, and ETFs give the everyday person an ability to do? It gives that everyday person an ability to not just work for money, but to get their money to work for them. And you know what? Most W-2 workers just think, what could be better than getting my money to work for me while I'm working, and they put their head back down. But I'm here to shake up that paradigm. Getting your money to work for you does not create wealth. I know that could really shake up a lot of people, but when you look at just say the long-term return of the S&P 500, say it's 10% over the long term, once you correct that for inflation and emotion and taxes and fees and volatility, real returns are typically 0 or less than 0 when you do the math. Now, I know this can shake up people if they're not used to investing in real estate or they're not used to investing in real estate efficiently. Getting your money to work for you does not build wealth. That's what those vehicles are designed to do. That's all that they're designed to do. All right, so how is wealth built and how is that accessible to everyday people? You probably heard some of this before, but I'm going to put a new spin on it. You build wealth for yourself by taking control and ethically getting other people's money to work for you. It's about OPM, other people's money. Okay. That's a part that a lot of people have heard before. That came from the Rich Dad School. OPM, other people's money. Robert Kiyosaki. But here's the thing that one can do with real estate when they own it directly. You, as an everyday person with average means, can use other people's money 3 ways at the same time while you're doing good in the world, providing people with clean, safe, affordable, functional housing. How are you using other people's money 3 ways at the same time? Well, really, we can just harken back to that first fourplex that I bought and use that as an example. When I put a 3.5% down payment on a property, or today you can put a 20% down payment on a property and buy across state lines in a market that makes sense, what you're doing is you're getting the bank's money to work for you. You get the return on both your 3.5 to 20% invested and the portion borrowed from the bank. So that's the first of 3 ways you're getting other people's money to work for you. The second of 3 ways is you're getting that tenant income stream to control the mortgage, and hopefully there's something left over after all the property expenses are paid and you have residual income. And then the third way you're simultaneously getting other people's money to work for you is you're employing the government's money at scale for tax advantages like tax depreciation and a tax deferral on your capital gains, so you can legally never pay capital gains tax. So I'm really just scratching on the surface of that compelling why for making that paradigm shift from merely getting your money to work for you to getting other people's money to work for you. Again, 3 ways at the same time: the lenders, the governments, and the tenants. That's the paradigm shift here.
And so when you talk about your investing journey, you mentioned you went across state lines, and that's something that so many investors, they really balk at that. I mean, a lot of people that we talk to have kind of gotten over that nervousness. You know, they might not be completely over it, but by the time they come to us, they're a little bit more open to it. But there's a lot of people who just say, no, you know, I need to know the exact home. I need to know the exact neighborhood. You know, I need to be able to drive there. You know, if I'm going to do a flip, I need to be in there knocking down the wall myself and putting the wall back up. How did you get over the mental hurdle of, I don't need to buy the house next door because that's not going to really make me money. I'm going to buy the house, you know, 1,000 miles from me?
Yeah, it's a great question, Adam. Most of the rental property that I own today, I have never seen it before. I have bought properties that I have never seen, owned them for several years, profited with cash flow, and sold them for more than I bought them for, and I have still never seen them. And I think really an important thing to remember with buying out-of-state properties or even properties in your own local market is that realization that the way I like to think of it, Adam and Zach, is in real estate, the property is only the 4th most important thing. But most people, when they think about real estate, they think about, oh, okay, what's that next property I'm going to go get? Well, that might work, but you're probably setting yourself up for failure. You're probably not being very strategic. So what's more important than the property? Number 1 is you. What do you want real estate to do for you? What kind of outcome are you looking for? Are you looking for cash flow and the production of income, which is common, especially when you're new to real estate investing? It can be easy to fall in love with that residual income stream. Or do you want appreciation? Or do you want tax benefits? Or are you looking for a lifestyle benefit that you might be able to derive from the property because maybe you want to live there a few weeks a year or something? So number 1 is you. What do you want real estate to do for you? Once you have that figured out, the second most important thing is the market that you're going to buy in. We can think of markets in a few different ways: the mobile home market, or the single family home market, or the apartment market. Oftentimes we think of that in terms of geography. For example, if your most important criteria was cash flow in number 1, then secondly, the market. Number 2, well, you typically want to buy in the Midwest and South, in a market that has a good diversification of economic sectors so that tenant can continue to pay the rent. And then the third most important thing is that team of professionals that you surround yourself with, especially that all-important property manager, because they're the glue that makes this stick together, whether you invest in your home market or out of state. Having that competent manager, we all know that a bad manager can just go ahead and ram a good property into the ground. And once you're strategic and you have those three things set, you, the market, the team, then fourthly, and only fourthly, are you ready to look at the property? And you'll get quite a bit of confidence when you've got 1, 2, and 3 already figured out. And you can understand why the hierarchy of property fourth really makes a lot of sense. And just imagine if someone tried to do this backwards. Maybe they fall all in love with the property because they think it looks pretty, or they even think maybe the cash flow is good, but maybe they can't get a respectful rent-paying tenant there. So they get in love with the property and they buy the property. Then they try to find a manager in the property because they decide they don't want to do it themselves. Then they try to figure out the market, and it's too late that they already bought. So it doesn't work that way. So that's really the number one thing that gave me confidence to buy out of market, understanding that hierarchy and that the property is important, but it's only fourth.
Oh man, that's such a great breakdown, Keith. Thank you so much for doing that. And so simplistically, I mean, we talk with people all day long about removing the emotion from it and building your criteria and plan. And it's okay not to know exactly, what all of those criteria is on the front end. I mean, that's part of investing is okay. Investing and doing it and then developing that over time. And those strategies in I mean, ourselves included, that changes over time. Our investing strategy, it has changed. We were very focused early on in our career path with trying to obtain cash flow and investing in areas specifically out of state. And that's what allowed us to take our investments to the next level and create our business. And now, our investing is highly dependent on the tax benefits. And being more, passive in our investing. And so it evolves over time, but as long as you're taking action and always being conscious of those things, I think that's the right path to follow. So that was just exceptional breakdown of that criteria. Adam, we're going to have to quote Keith on that quite a bit.
All right. We will
generate a few memes off that.
Yeah.
Yeah. Property fourth.
I want to talk about Keith, because I mean, you are very much well respected as a professional in the industry, especially on market analysis. I mean, you have millions of listeners across, I think, 200 plus countries, and you've been in the space for a long time and been very successful with the content you're putting out and your investing career path. But you kind of breezed over early on about this kind of 10% return that we would anticipate with stocks, and how that's really just wiped out over the 5 criteria that you right. talked about. Do you mind actually going through the math a little bit with that and breaking that down a little bit for us?
Yeah, in an audio format, it's hard to go too deep with the math, but I talked about how inflation, emotion, taxes, fees, and volatility are 5 simultaneous drags on a 10% return. A lot of investors, they aren't even thinking today that inflation is between 8 and 9%. I think we all know that's a farce, because the CPI, the Consumer Price Index that the Bureau of Labor Statistics puts out, is heavily manipulated and diluted. But if we just simply take that at face value and just simply say inflation's 8%, well, on your 10% return minus 8% inflation, you're already down to 2%. And that's before the effect of taxes and emotion and fees and volatility. And really, the emotion and the volatility, they play together here. A lot of people think that they can overcome the emotions and overcome that temptation of buying high and selling low, but yet that's what so many people tend to do. They will often buy high and sell low in the stock world and the mutual fund world, even when they know they're supposed to do the exact opposite of that. And why is that? Why are humans often predisposed to make those decisions at absolutely the wrong time? It is part of that emotional journey that plays in here to stocks, and it doesn't so much with real estate. Real estate moves really slowly. It's not very volatile. So with stocks, when the price runs up and up and up and up, if you're not in the market, you want to get in. You get bathed in reading all this media about how, hey, everyone's making so much money, and you've heard that your friends are making so much money. And the more it goes up, you experience FOMO, fear of missing out, and you justify getting in when the market is running up. Really, I think it's on the emotion of momentum and that fear of missing out. So often you've bought higher, And then oppositely, when the market begins to go down, as it often does because the stock market is volatile, the overriding emotion is often discouragement. The market has gone down and down and down, and I am so tired of losing money, and it continues to go down and down and down. A bear market is seen as a 20% drop in the stock or the share price, which happens every few years in stocks. And you justify the emotion of selling because you just know that you're not going to have to get up and suffer more losses. You just justify that you're cutting your losses. What have you just done? Now you've bought high and sold low. So that's the emotion and the volatility component that I'm talking about with all the other drags on stocks that a lot of people just don't take into account. Inflation, emotion, taxes, fees, and volatility. And I'm telling you, that emotional one, that's one that investors say, oh, no, I can deal with the emotions. I can deal with the emotions. I won't buy and sell at the wrong time. But yet people typically do. It's kind of like people, 8 out of 10 people say that they're a better than average driver, for example, but only 5 out of 10 statistically can be. It's really that effect. But people are often overlooking this and not determining what their real return is after adjusting for all those drags.
Yeah, if it was that easy, then everybody would be a multimillionaire. It's like you see stock markets plummeting, right now, and you don't hear anybody saying, "Oh, now's the perfect time." It's, this is never going to end. It's going down. It's going down. So yeah, it's
And I just think about the timing of retirement too, right? Like if you just bought, and dollar cost averaged for many years, and then you just did a big picture, like your retirement timing is in 5 or 10 years, and that's when you're going to, shift over to, more conservative type of investments or kind of cash out and start to take distributions, whatever the case is. Like what happens if the market the tub then? I mean, you're kind of like, now you got to stay in, for another 10 years to rebuild and delay your retirement. I mean, again, I think that just goes back to the idea of real estate having more control.
A lot of these things that I'm talking about, inflation especially, is actually a boon, is actually a wealth enhancer to real estate investors.
Well, let's switch gears then. Let's talk about that a little bit with how real estate is, performing right now. There's many people that are potentially like, oh, I want to, wait, and I'm concerned. We have a high inflationary environment right now. And I always mention real estate can be a tool in times like this, and they're necessary in times like this. But I mean, let's talk about kind of what you think about the market with interest rates, inflation, recession. Should we still be investing right now?
Yeah, well, to talk about the state of the real estate market overall, in a sense, the market has normalized in this past year. It certainly isn't normal everywhere. One place where the housing market's normalized is that those negotiations between a property seller and a property buyer, just that negotiating and that offer part, that part's pretty balanced now. In the last 1 year, the housing market has therefore become worse for sellers and better for buyers. Even a year ago, a buyer couldn't very well do what they can today. If you as a buyer, if you want to buy a property today, you have substantially more latitude and time to do so. You don't have to offer all cash. You probably don't have to compete with as many offers if you're a buyer of income property today. And yeah, you can actually do things like have an appraisal contingency, basically that third-party verification, making sure that you're not paying too much for the property. You can have some inspection findings. You can have the time to actually get an inspector in there and have that seller make what are almost always repairs to the property. I always suggest that one gets that inspection. So that part of the market is pretty balanced. There's one unbalanced part of today's real estate market, and that is the fact that the probability of a real estate crash is 100% certain. 100% certainty of a housing crash. And you might be thinking, how can a person say that? What are you, clairvoyant or something? What do you mean? How can you say there's a 100% certainty of that? That is because the housing crash already occurred. In April of 2020, there was a housing supply crash where the supply of available homes dropped 60%. If we want to make crash synonymous with bear market, we can say a crash is 20% or more in the loss of a value of something. we had a 60% housing market crash. April of 2020 was that inflection point when the supply of available homes in the United States did not make its seasonal rebound. And the reason I'm bringing this up is this incredible dearth of supply that we still have, and we're not going to get out of anytime soon, that has driven so much investment behavior in the market. So the fact that we've had a supply crash actually puts somewhat of a support level and helps hedge us against a price crash.
Yeah, I will. I want to switch back real quick before I ask a question on what you just said, and that is we talk about inflation right now, and yes, it's high. But if you want to see something real bad, check for deflation. If we get into a deflationary environment, that's much worse. But I mean, the Fed targets 2%. So of your 10%, at a minimum, their goal is you're going to lose 2% every year there. But when it comes to the numbers you were just mentioning, with the dearth of inventory, I mean, Fannie Mae came out recently and said, first off, we're 5 million homes short because we've had 12 million households formed in the last, I believe, 7 or 10 years. And we've only had 7 million homes built over that time for, in excess of what we had. And so we have a 5 million home gap. But then we also have, you talk about how people can get inspections, get appraisals. There's still only 3.3 months of inventory out there across the country. So even though it's a whole lot more than it used to be, it's still not a balanced market like we think of with the 6 month time. It's just people are so used to selling their homes in 3, 4, 5 days that the idea of waiting 2 weeks to get an offer on their home is just, what on earth is going on in today's market, right?
Yeah, that's right. You bring up inflation a few times there and how that affects the market. Well, of course, if you can get a 6% mortgage rate today and inflation is 8 or 9, that actually increases your prosperity in the short term when you're borrowing for less than the rate of inflation. I don't know that that's going to hang around for the long term. If you get a 30-year loan, okay, that might be a nice windfall here in the early years. But yeah, I mean, you're basically creating arbitrage when you're able to borrow at, say, 6%, when inflation is at, say, 8%. We know the tenant's already paying down that loan for you, but you also have a windfall because when you borrow dollars at less than the rate of inflation, you get to pay back the bank. Of course, we know your tenant's really subsidizing that, but you get to pay back the bank with dollars that debase on the bank faster than their interest rates can accrue on you. That's why it's a smart trade for real estate investors. And it's one of the ways that real estate investors benefit with high inflation. There are a few ways. That's just one of them.
Yeah, absolutely. Because we're seeing, in this inflationary time, you get in at this rate, getting the arbitrage, plus you've got the inflation pushing up prices, which just helps you over the long run as well. And then, 5, 6, 7 years down the road, whenever you have a 6% rate and someone who bought 6, 7 months ago has a 3% rate, guess who's going to want to refinance first?
Right. So we can play this inflation in a few ways, Adam and Zach. Another way is if we can think of inflation being reflected in rents, something that we're extremely interested in as real estate investors. CoreLogic, they even tell us that year over year, we have about a 13.4% increase in rents in just the last year. And that's just for single family rental homes. I think apartments are a little bit behind that. But if we just say that you get a 10% increase in rents over time, which is partly fueled by inflation, okay, well, we know that's of benefit to a landlord, but something that a lot of landlords don't realize, even experienced real estate investors, is if you get a 10% increase in rent, that might be a 20 to 25% increase in your cash flow. And this is huge. This is the money that you feel in your pocket every month. And what creates that effect? That's because typically you have a loan on the property. Your principal and interest payment stays fixed. So your cash flow calculation is your rent income minus your mortgage and all of your operating expenses. So really the more leverage you are and the more that you've borrowed, again, borrowing enhances your wealth like I just described earlier. It also increases your rent in an outsized way because it increases your cash flow. It's big. It's the money that you feel in your pocket every single month. If you're looking to grow your passive income from real estate, pay attention. My Property Stats is a deal analysis tool developed by an active investor to cut the time it takes to analyze any deal by over 90%. For any real estate class, you can calculate the exact price to pay to hit your cash flow and IRR goals. Build a world-class pro forma. Calculate the most you should pay for a renovation. Run multiple scenarios with a comparison tool and more. My Property Stats is the all-in-one toolkit for real estate investors. That means more deals, more cash flow, and more returns. Go to mypropertystats.com/GRE now and use the coupon code GRE to get 10% off your first year. That's just $90 a year for a tool that can save 10 hours per deal. No more spreadsheets, no more juggling multiple files. Use coupon code GRE to get 10% off at mypropertystats.com/GRE. Knowing the difference between a turnkey provider and a vertically integrated rental property company can cost you hundreds of thousands of dollars over the life of your investment. Some companies sell you a property they don't own, renovate it with contractors they don't control, refer you to a property management company they don't manage, all in multiple markets because they can't source enough inventory. That's why truly passive investors work with our friends at JWB Real Estate Capital, perhaps the country's only vertically integrated rental property investment company. They operate in one market, Jacksonville, Florida, and their whole job is to make investing in rental properties easy for you. In fact, because of their vertically integrated approach, their clients have gained 79% more home price appreciation than the overall Jacksonville market since 2013. Find out more about why it pays to invest with JWB. Call them at 904-677-6777 or go to jwbrealestate.com/GRE. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
This is author Kristen Tate. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
I love that stuff, Keith, that we're getting into the nitty gritty of the details with, just how beneficial real estate is, right? Like if we really could map this out, I mean, most people think about cash flow. They understand a little bit of depreciation. They understand a little bit about depreciation and taxes, and the amortization and the debt pay down over time. But when you really look at the big concepts of holding debt over time and considering inflation and actually running the numbers of, a small increase in rent and what that really is return on investment wise, I mean, it's just astonishing how much real estate performs compared to other asset classes. Obviously, we're all believers. We've drank that Kool-Aid a long time ago and been successful with it. And I love that you went through the real estate crash and put that in perspective from a supply issue that we're still dealing with today, right? I mean, we get this question all the time of, well, maybe I'm going to wait, or maybe I should just wait. We interview many successful real estate investors, and no one says, I just timed the market appropriately, right? They all mentioned they've consistently bought real estate time and time again, even back in 80s and 90s when points were, interest rates were in the high teens. That's to put things in perspective. Interest rates are just normalizing. But I think the big picture would be, you're still investing today because of all these benefits that we talked about. And an interest rate really doesn't matter in the grand scheme of things. And we still have a large discrepancy between supply and demand, especially in some of the areas that we're particularly investing in, like Southwest Florida and Texas and Alabama, for example, where, just because of how slow the construction is taking, because we're still playing catch up, there's still more people moving every single day than housing opportunities that are becoming available. So, I mean, if you're in the path of progress in areas like that, you're bound to be completely fine. Would you agree with that, or anything else to add?
I would. Yeah, you bring up a great point. It's difficult to time the market. The best investors, they just keep investing because really the question is, even today, where else are you going to invest and get a return in all the ways that you do from direct real estate investing with a loan? I have long pointed out that real estate investors are often paid 5 ways simultaneously: appreciation, cash flow, loan amortization, which is actually a benefit that you don't have in your primary residence, because in your primary residence, you pay down your principal. In your rental, your tenant does. The fourth is that basket of tax benefits, which I briefly touched on earlier. And then the fifth is the inflation profiting benefit that you get on the long-term fixed interest rate debt. And over the long term, any one of those 5, sometimes they're up and sometimes others are down. Like appreciation, it's been down. That was up about 20% year over year last year. That's moderating, that's normalizing. So the rate of appreciation is down. But cash flow is poised to go up, like the rent increases that I discussed earlier. The third way, with the loan pay down, that's actually down a little bit because mortgage interest rates are up. The fourth way, the tax benefits, they haven't changed much lately. And then the fifth way, the inflation profiting benefit, well, that's actually been up, because if you borrow $1 million at 8% inflation, you only owe the bank back $920K in inflation adjusted dollars after year 1, for example. So when you're getting paid 5 ways and you understand all the profit centers that real estate has, you just need to realize over the long term that sometimes some of those 5 are up and sometimes some of those 5 are down. So that's how I think of it long term. And it's really asking you, where could you get a better return long term? When you add up all 5 of your returns and sum that up in a total rate of return, I found that anything less than a 20% annual return from real estate is actually pretty disappointing. Real estate pays 5 ways.
I can handle a 20% return. I think most people would agree with that one. But you talked about rents, and I just want to point out something. I was looking up some stuff for a YouTube video I made the other day, and I found that 1-bedrooms, this was apartments obviously, but 1-bedroom apartments went up in rent in 97.83% of markets, and 2-bedroom apartments went up in 100% of markets just over the last year. So I mean, it's something like we were talking about, the rent pressures that are there right now, especially as interest rates have gone up, have really, if you've got a 2-3 bedroom home and you're not increasing your rents, you are cheating yourself out of money right now. And so you've got to do it. I mean, because eventually taxes are going to go up and you're going to be paying more there because your home values are going up. And so for people who are not raising their rents because they want to be kind to their tenants, well, you're costing yourself money over the long haul, because your tenant's not going to be like, oh, I'm sorry, your property taxes went up, let me throw you an extra $40 a month for it.
Yeah, you're totally right. I'm really glad that you brought this up, Adam. And I expect the homeownership rate in America, which is currently between 65 and 66%, it's a little closer to 66%. I expect that to go down these next few years, which means there should be more renters. So currently, if you have about 66% of America as homeowners, the inverse of that, about 34% are renters. I expect the homeownership rate to go down. So if the homeownership rate goes from 66 to 64, the proportion of renters goes from 34 up to 36. There is going to be more demand for rentals. There already has been. It's reflected in some of the numbers that you talked about. Appreciation, I don't expect appreciation to be outsized anytime soon. 77% of single-family rental residents now renew their lease. That's what John Burns Real Estate Investing tells us. Residents are renewing their lease. They want to stay as renters, and more often than not, they want to continue to rent the unit that they have rather than move, which is really good for landlords, because we know as landlords, few things hurt us like turnover, and vacancy does. So if we look at the housing market and really, why are tenants staying longer? Well, the obvious one is that home buying costs have soared and they can't afford that property. Oftentimes they can't afford that down payment to get into the property, so they keep renting. Another reason that single family rental residents are renewing their lease, and apartment dwellers are as well, just not at the retention rate that single family renters are, is that at lease renewal, rental rates increase. But rents on vacant units, they increase even faster. So tenants renew. You know, as a landlord, that it's harder to get a big rent increase on an existing tenant as it is a new one in a vacancy. And the other reason that residents are renewing their lease and they want to keep renting is just, we touched on it before, this national paucity of housing supply, because oftentimes there's just simply nowhere else for them to move. They want to know that they have a place to live with this astounding dearth of supply. So this is why residents are renewing their lease and staying there.
Excellent point, Keith. We've touched on quite a bit about the real estate market right now and how it's still strong for many reasons, and why now is still a good time to invest, and quite frankly, why all times are good to invest in real estate over the long haul. Is there any points or stats you want to throw out about just kind of the general economy as a whole right now? Technically, we're in a recession. That also is one of those things that just concerns people, right? It's like, okay, what's going to happen? Just not even looking at the real estate sector as a whole. Where do you see our economy going from your point of view?
Are we in a recession? That's a big question for people. A lot of people point to the technical definition of a recession. They say, yes, we are in a recession because we've had 2 consecutive quarters now of contracting GDP. That has happened. The NBER, the National Bureau of Economic Research, they're the ones that actually make the call on this. Yeah, it's kind of weird, like it's some judge sport, like judges sit around like it's Olympic figure skating. And sometimes it isn't until months or years after the fact that they go back and say, oh, yeah, that was a recession in 2022. So we won't actually know. And one reason that not everyone's ready to call it a recession is that jobs numbers have continued to be strong. In general, if you want a job, you have one. Big data companies have made layoffs, but a lot of smaller service sectors, they're hiring people. So that's a pretty nuanced topic. But, that's on the recession subject. But when you ask about the economy overall, how is it doing? I think one thing I really want to emphasize that not enough people are emphasizing about the economy is that when inflation, about 8%, is higher than wage increases, about 5% now, this diminishes the purchasing power of the everyday consumer, and this degrades the quality of life of the American family. And this is a big deal. For decades, we haven't had wages keep up with inflation. And, I don't know about when you were growing up, but when I grew up, my father, he was able to provide for us with one full-time job. He didn't have a high level of educational attainment, and my mom could stay home with us. So when you look at a generation plus now of wages that don't keep up with inflation, what's that mean? Both parents have to work. So this is happening again in high inflation. What happens when both parents have to work? Well, children just aren't raised the same, and it can make society unravel somewhat, or, both people need to stay employed. It often takes 2 incomes now, where it only took one a generation or more ago. So this is huge. And unfortunately, that's the way that the economy has trended with this high inflation. So I think that's actually more important than are we in a technical recession or not.
Yeah. That's a good point.
The good part about that, though, is wages tend to be sticky and inflation doesn't tend to be as sticky. I mean, I looked at an economic report. I would think it was the New York expected inflation over the next 36 months. And as Zach and I have talked about before, and as I'm sure you know, a lot of times inflation runs up because people expect inflation to run up. It definitely helps with that. But it was at about 3.5% expected over the next 3 years to be averaged out. So if it drops down to 3.6%, the likelihood is that 5% gain in wages is going to stay at that level, not drop down. So maybe the renter will actually end up ahead at some point in the future, just as you were saying, not right now in today's world. So.
And of course, we got to look at what are, actual inflation numbers, right? CPI and everything. But the bigger point here, I think, Keith, is, and for anyone listening to this, is like, we need to do something with our finances, right? To outpace inflation and to, try to provide the lifestyle. I mean, everyone is interested in investing in real estate for those reasons. That is, at least in our community. And so, you're taking the right steps. I mean, for someone that is kind of newer to investing, though, and that hasn't, maybe got that first property out of state, or they're wondering how to scale. I mean, for someone that's a little bit concerned about where we're at economically, or whatever the case is, or they just don't know where to invest because it's a shiny object syndrome, and it's kind of daunting sometimes when you're first starting to invest because there's so many different ways to participate in real estate. I've always thought that personally, and we invest in a lot of different ways, and we offer a lot of different paths for investors to participate in real estate investing. I personally always thought that just home ownership, while syndications and things like this are good, like, okay, passive, yes, but the true benefits, those 5 ways that you talked about, is from actual physical property ownership. And I think that's where real wealth is created long term. But I guess the question I'm asking you is, what advice would you give to someone that's a little hesitant right now, or they're trying to decide where do I buy my first property, and they need some direction?
Start small, but think big. I would really begin with that. You're never really going to know how it feels as a real estate investor until you jump in and do the real thing. And nothing's more difficult than that first one. What's a concrete example of starting small but thinking big? I think it's starting in your mind, where an outsized life isn't built by living below your means. It's built by growing your means. And real estate's a vehicle for doing that. How does start small look in the real world? Starting as small as buying a $150,000 rental single-family home with a loan in a long-term place that's had good cap rates, whether that's a Memphis, Tennessee, or a Little Rock, Arkansas, or an Indianapolis, Indiana, or those markets in the Midwest and South that are conducive to a high ratio of rent income in proportion to a low purchase price. It's getting in and doing that real thing, and going through the steps and qualifying for a loan, and realizing that if mortgage rates drop later, you can refinance. But it's really getting in and doing it. You're never going to know how it feels. And yet, just buying that $150,000 or so single family home, you do go through all the steps: inspection and appraisal and qualifying for a loan, and actually getting a tenant income stream every month, residual income. You're going to see how that benefit feels. Start small, think big.
Yeah, I remember when Erin and I first got started. Erin's my wife, Keith. You probably don't know her, but we first started and we said, all right, we're going to get one, maybe 6 months from now, we'll buy another one, and then, do 1 or 2 a year. And then we got that first one, and that first rent check hit, and our mindset switched and was like, all right, where's the next one? Let's go under contract on the next one. We're not going to wait around and sit around here and twiddle our thumbs for 4 to 6 months. We're going to get started now. And I think an important thing for some of our listeners who haven't looked into out of state and maybe live on one of the coasts is when Keith talks about a $150,000 home in Memphis or Indianapolis or Kansas City or, Alabama, these are not awful rundown homes. In California, yes, it would be. It'd be a closet that was falling apart. In New York, you're talking about a closet that's falling apart. In these homes, in these areas, you're talking about a 1,300 square foot home in really good condition that's ready to be rented out. They're completely different. You have to change your mindset from where you're probably living to where you're probably investing.
I love that, Adam. And it's getting that firsthand experience, right? That's really what it's about, is getting in the investor mindset. I always remind people that are first starting out that first property probably isn't so important financially, but it 100% is mentally and emotionally. And it's just getting in that investor mindset and doing it. Not every single property you buy is going to be a home run, and not all of them are going to be easy, profitable properties. Real estate, we're housing tenants. There's tenant issues. You'll encounter that, but you learn from it. You get in that investor mindset, and then you naturally learn how to scale over time. I think pretty much everyone's success can be traced back to some degree of that.
Sure, just like Adam and his wife found out. You found out because you did. You started small and thought big. So you really knew how it felt when you were doing that. So now I own properties in multiple markets across the United States, even outside the United States. So what does my life really look like in managing that in these properties that I own directly and other property managers manage? I get an email from my property manager. I have a manager in one market that manages 5 properties there, and a manager in a different market and city that manages 4 properties over there. And I typically just get one monthly statement where I see all the income and the expenses for that month. The property manager takes 8 to 10% of 1 month's rent for doing that for me. Sometimes I reply to those emails like, well, hey, why didn't that rent come in? Or is that person going to be a little late or something? But most months, I don't even have to make any sort of reply to them. And that property manager automatically puts that deposit into my account monthly.
Yeah, it's a horrible life that involves so many hours of work every month. I always tell people, it's like, man, I'm in 4 markets and I spend an hour a month consolidating everything and responding to any emails that I actually have to respond to. I mean, it's not nearly as time consuming as some people tend to think it is. So, Keith, I want to thank you so much for joining us for this interview. It's been fantastic. Are there any last little nuggets of mindset or ways to think of returns or anything like that you want to leave our listeners with today?
Yeah, I really want to emphasize growing your means, expanding your means, and the fact that, with what I started with, I really want to emphasize using other people's money ethically. That's how you really get ahead. And you can do this without having any sort of specialized degree or any certification or any letters behind your name. This is available to you, to everyday people. So it's really about you, asking yourself when you want to do something different. Normal people invest through their employer-sponsored retirement plans. And I used to as well, back when I was a W-2 worker, until I realized that there's something more out there. But the thing is ask yourself, do you want to live a normal life? I mean, normal is really just a synonym for mediocrity in my book. So you want to get residual income streams so you can buy time to live the life that you really want to live. Yeah, well, I hope you enjoyed that interview of me. There's one item that I did discuss in there where I want to give credit to the real estate guys, Robert Helms and Russell Gray. When I was talking about how the property is only the 4th most important thing in real estate investing, they didn't say it exactly that way, but I'd like to credit them because I learned some version of that from them. So check out their show. To get an update on real estate inventory today, here near the end of the year, the Fred Active Listing Count data, which is the same source that I have cited here for more than a year, inventory is up a good bit. The count of active single-family and condo/townhome listings, that's exactly what we're talking about here. By this measure, now a normally supplied housing market is 1.5 to 2 million homes. That's historically normal. Now, 10 months ago in February, the housing supply bottomed out at an absurdly low 350,000 available homes on the market to buy. That is it. Just incredible. So therefore, only about 1/5 of what America needs. Now that was back in February. Well, now it is up a good bit. Really from August until today, it's been pretty steady these last 4 months here at 700 to 750,000 homes. So though the American housing supply is up off the bottom quite a bit, it's still not even half. It's only about 40% of what's needed. So still such a long way to go to get enough housing supply. And what those numbers don't tell you is that the workforce type of housing that make the best rentals, the properties that you most likely want, those properties which are just below the median housing value, well, those housing types, they're even more undersupplied than the overall housing market, and they're the same home types that make the best homes for the first-time home buyer. Now, I've got a question for you, and then I'm going to give you my opinion on the answer. For long-term rentals, if a 10 is the best, highest end, most luxurious housing with gold-plated bathtubs and crazy, ridiculous scenery and views right on a beach, if a 10 right there is what we're calling the best, and a 1 is the worst housing, say that's in a trashy neighborhood in an area that's unsafe, well then my question to you is, from 1 to 10, where do you think the most profitable housing is for cash flow? Do you want to take a guess? I mean, I already gave you a clue today with how I discussed that that's just below the median housing value. Well, the best answer I can give, and this is my opinion, but a fairly qualified answer as a 20-year real estate investor and an active member of the Forbes Real Estate Council here, the answer for the best profitability on long-term rentals is a 4. Yeah, a 4 out of 10 for cash flow. Yes, sure, in some markets, one can make the argument that perhaps it's a 3 over there or a 5 over here, but going too low in an area just means that 1s and 2s, properties in that zone, they don't appreciate much. And it's also hard to find tenants that respect the property. And then up on the higher end of long-term rentals, the numbers just do not work over there. But yeah, a 4 out of 10, that is the best number. Although for short-term rentals, well, it's going to be higher. You might have markets where an 8 out of 10 or higher works for those. Well, we have got some interesting shows coming up here on GRE, including what about the eat the rich sentiment in America, meaning that wealthy people should be trashed. Well, should the wealthy be disparaged or should they be celebrated? We'll have a show on that. Also, what's the most important question that you can ask yourself in all of real estate investing? And it's a question you probably never heard before or have never even asked yourself. It's the most important question you can ask yourself in real estate investing. I've got a segment on that. Also, in the new year, we're talking about the interesting nuances of one geographic real estate market that we've never talked about before here on the show. And you might be surprised that we're talking about this particular metro on the show, because you might have expected we would never talk about it. You're going to see what I mean on that one. Well, season's greetings to you, whatever holiday you celebrate this time of year. Hanukkah is already underway. Happy Kwanzaa. I celebrate Christmas. Merry Christmas to you if you do too. And a sincere happy holidays to you and your family from me and all of us here at GRE. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.